I hope everybody's doing safe and well. We got quite a few things to get onto today. We have continuation type trades, so that would be on West Texas Intermediate, on the bonds, on and when I say the bonds, I mean longer term bonds, and also on equities. And then I also have some Elliott Wave-esque trades, or somewhat Elliott Wave. It's an Elliott Wave pattern. It's a chart pattern. It's a triangular chart pattern. Might be you might call it Elliott Wave, I guess. But it's a chart pattern, and we want to have to talk about that. But before I get into any of that, let's first start talking about oil before I get into the bonds and the stocks. So with oil, I believe it was a week ago that we came out and said that oil would go lower, and it has gone lower from when we said it would go lower about a week ago. And what we mainly said were the reasons for it going lower was that the production cuts, and we gave our logic behind it. You can go look at that video. But the production cuts were not going to make much of a difference in oil going up or down because the production cuts, if there were any, were going to be very minimal. And everybody thinks that 10 billion is a lot, but it's really not much at all, and it makes zero difference. And at the end of the day, Saudi Arabia and Russia actually do want oil to go down in the short term because Saudi Arabia and Russia can drill oil at $10 a barrel easily. The United States cannot. So they can price gouge the United States out of drilling oil and bankrupt all the American oil drillers so they have more power. And so in the short term, they do have pain, yes, but they're able to drill oil for very cheap amounts. So it doesn't affect them as much. Even though it does affect them, it doesn't affect them as much as it does the United States. But the United States really wanted this to happen because the oil jobs would go away and the oil drillers would be bankrupt. So we just have a continuation play on that. We're still bearish. And so Russia and Saudi Arabia, short term, they would take on some pain, but long term, they actually want the oil price to go down because eventually means that they get more control over what's going on in oil because now the United States produces basically more oil than a majority of the OPEC nations. And so OPEC wanted more control, and the United States is not in OPEC, so they in the short term are okay with lowering prices because it pushes all the American producers who are very inefficient, who drill oil for $70 a barrel out of the market versus the Russian Saudi Arabians who can drill oil for $10 a barrel or even cheaper sometimes. If they really wanted, I think Saudi Arabia could possibly drill oil for $5 a barrel. So they're almost guaranteed to make a profit, but the place like Whiting Petroleum, I think WLL is the ticker symbol for that. So looking at Whiting Petroleum, they basically went from this high up here 54 years ago, but more recently, just a couple of months ago, in January, they were up at $8 or $9. Now they're a penny stock at 36 cents. So this is a perfect example of what we're talking about right there. So still looking bearish on US oil. The next one I wanted to take a look at was TLT, so long-term bonds. And these have been trading bearish with no correlation. So we started getting bearish, I believe, somewhere around here. I think I came out and said that it would go lower. And it has gone lower, but it's gone lower sideways to lower, slightly bearish. And the reason that we said it was going to go lower was that everybody was, if you have a 60-40 portfolio, for example, you put 60% equities, you take the other 40%, you put in bonds. What's starting to happen is that instead of putting the other 40% in long-term bonds, they're putting in short-term bonds, maybe putting in short-term bonds that get settled, that mature in 2 years, and then rolling it over, and then rolling it over, and then rolling it over 15 times for the next 30 years, instead of putting in a long-term 30-year bond. And so there's this move out of long-term bonds because of such low interest rates compared to all the high inflation. But simultaneously, the Fed is buying them up. But with that said, it's gone down a little bit. I think we will have a time though where it goes down even more before the Fed really starts buying it up. And from there, it will go bullish. And then the next one I want to talk about is the SP 500. And I basically in the video had showed you something like this, and I said that at 50% retracement it was going to start to go sideways. So I think 50% retracement right here, and it was going to start to go sideways for a little bit, consolidate, and right here is going to go up and then go down. I think that it's more likely that it reaches this area right here and goes down from that fib now. So we basically said short-term bullish on stocks, long-term bearish. And so we basically said that it was going to get here, consolidate, go up, and then go down from there. I think the more likely scenario now, though, is that it goes from here, has what is a bit of a blow off top, and then goes down. And when I say a bit of a blow off top, I mean we can look at bonds and see what it had. In the bond market, we did have somewhat of a blow off top where it went higher, higher, and higher, like this. Trading basically, you can see these candles, they don't have much action in them. And then from there, it went higher, 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 and then had this blow off top. And we see this in so many names. Tesla, for example, we saw this over here, blow off top right here. And I think you're going to see something similar. Now, obviously, it's not going to be as big as Lumber Liquidators or Tesla or some of the others that we might have talked about in the past, because those names are obviously smaller than the U.S. equities are, but you're going to have something similar to that where it's going to go up even more, go up even more, and it's going to accelerate. I think it's going to hit that fib level, and then it's going to go straight down from there. So those were the plays that we were looking at. And also right here, before I go on, I want to talk about, and maybe you're looking at this because you're looking for a play that we were doing when it comes to basically this would be a bit of a triangular chart pattern. So triangular chart pattern is when you basically have a triangle that forms. So you have something like this, something that looks a bit like this, where you have a triangular chart pattern that starts to form that is eventually going to cause a breakout either in the bullish or the bearish direction. So it's either going to go down a lot from here, or it's going to go up a lot from here. I think in the short term it's going to go up a lot. It's going to then be a bull trap where it's going to be a blow off top, and then it's going to go lower from there. So I think that's what's headed for the S&P 500, short-term bullishness, long-term bearishness, or well, mid-term bearishness, I guess I can say. And then another one I want to take a look at is the Russell. A lot weaker on the way down, but on the way up it's a lot stronger. It still has not made the 50% retracement. And so with 50% retracement, all we want to take a look at is basically right here. So my target for the Russell is that it keeps on going up until we reach right here. So while all the others, the SPX, is already at a 50% retracement, same thing for the Qs and for the diamonds. And I'm not sure about transfer, so I have to check that. But the Russell still is not at a 50% retracement. I think we will get to the point where it gets to a 50% retracement, and then it then goes down from there. And so that's another thing that I'm looking at right there. And also, we were originally a lot more bearish on the Standard & Poor's 500. And the reason we changed a bit was that originally I'd come out and said I was bearish. And then, of course, the market went up. And if you look at it from a fundamental viewpoint, you would look at everything and you'd say that jobless claims were a lot higher. I mean, already right now, just within the last less than a month, we've had more jobless claims than we've had 50% jobless claims that we had throughout all of the great financial crisis, the GFC. So from an economic perspective, yes, it looks bearish, but then you have to take into account what the Fed was doing. And don't quote me on the timing of this, but I believe that right before the jobless claims came out, I think the Fed front-runned it, and they knew it was going to be bad. So they went ahead and they basically came out and said, we're going to do another $3 trillion of quantitative easing. And so the Fed came out and said they were going to do that. And that pushed the markets higher, and the markets totally forgot about the jobless claims. And I think that that is the cause of why we're having this rally. I don't think we'd have this rally at all right now, or even before the coronavirus. I don't think we would have ever recovered from Q4 of 2018 if it were not for the Fed. So that's something right there to definitely watch out for right there is the Fed and what they're going to be doing. Another one I want to take a look at is gold. So gold against the dollar depends on what currency you're trading it against. But again, we're starting to get this triangle-esque, I guess this wedge pattern right here. So and I'll go bottom of this wick right here. Generally, it depends on how you like to do it. Most people actually don't include the wick. Again, I'm not a technician. If you haven't noticed, I talk more fundamentals than I do technicals. So I'm not a technician under any circumstance, but most people do not include the wicks when they're drawing trend lines. I do because I like to take the extremes into account, but you do you, but you can see that there's somewhat of a wedge starting to form, and we're going to see a breakout. Looking at the fundamentals, I think is more likely to be a bullish breakout than a bearish breakout, but we are starting to see a breakout. And when it comes to the balance sheet, every Thursday at 3 o'clock every Thursday, we see the Fed's balance sheet starting to come out. And what I looked at was that, and we've been talking about this on the channel for quite a long time, but we're expecting a stagflation. And this is before the whole coronavirus thing. Since this channel started, we've been talking about. This channel hasn't been around for that long. It's been around for less than a year. But we said that the next recession would be inflationary. And it's starting to turn out that way because, and again, if you're trading technically, you really won't care about this. But if you're longer term like me, you tend to care more about the fundamentals, global macro side of things, then you're going to pay more attention to this. And that is that the balance sheet grew by almost 300 billion last week. But that was actually an improvement from the week before that, where it grew by almost 600 billion. But obviously, big balance sheet growth either way. We're basically within the last 3 weeks, we went from 5 to 6 trillion on the balance sheet. Of course, new record highs. But I think that just from a fundamental perspective, the gold market is not yet taking that into account. I think it could go bullish from here. And so I think it's more likely to break bullish, but of course I could be wrong on that because those are longer term fundamentals, and the short term price action may not match those longer term fundamentals. But we've been talking about that for quite a long time, and view longer term perspectives on the precious metals and why we're so bullish on them. But that's the way to play it right there, is bullish right there. Another thing you can do is that you can buy a straddle or a strangle. So either the price has to move up a lot or down a lot, and as long as the price doesn't stay the same, you make money. So you can buy a straddle or a strangle. You can also do a strip straddle, strip strangle. That's basically when you buy 2 calls and 1 put, or 2 puts and 1 call. So buy 2 calls and 1 put, and you can go about it that way. You can do the same thing with the S&P 500 when it's going to have a breakout. And simultaneously, while you do that, what many people like to do is they like to do leg and vertical. Many people call it different things. I know YouTube channels like Trading Fraternity call it a ghetto spread, for example. But basically all it is that you might buy an at-the-money call for, say, $10, and then you go out of the money 5%, and you put in a limit order to sell that call for $10. And if you get filled on it, you basically now are net paying 0. So the worst case scenario is that you lose 0. So you now have a guaranteed profit. And that's something you can do right here with gold and with the S&P 500. And then I also want to take a look at silver. So when it comes to silver, we had a video that came out. This is more continuation play again. We had a video that came out when silver was, I believe silver, I think this is time. We came out with the video when silver was about right here, saying that this is the lowest silver will go, and that it was probably going to go a tad bit lower and just have a higher low, which it did, and then it's going to break bullish. And so far it's going bullish once again. It's just following gold a lot higher, and I'm more bullish on silver than I am on gold. Now, a longer term play that we've been talking about for quite a while is Newmont Mining. And of course, Newmont Mining is breaking bullish big time. It is the, I think in all the S&P 500, it is a stock that is the stock that is the third highest all of this year. So the third most outperforming stock. I think the other two, I think Zoom Video might be in the S&P 500. I'm not sure, but that might have outperformed as something else. but throughout 2020 is the third most outperforming stock in the S&P 500. I think by the end of this year, it could be the one that outperforms the most. We've been talking about this one for quite a while. Just year to date, it's up almost 40%. And since we've been talking about its first episode, where we talk about why we're ultra bullish on gold, it's basically up 40 to, well, it's up 50 to 55%. And it's up 40% year to date. So it's already gone quite bullish. I wouldn't jump in it at this point, even though I still think it's undervalued long term. I would wait for a pullback. There are other names though. So when I said that this is the lowest silver will go, I actually played it with AG. This is First Majestic Silver. I believe I've talked about this one on this channel before, but I basically got into it just about, I would say, about right here. So I'm at about break even from the time I got into it, which is about right here. But of course, this one had a big day too, up 11%. And the reason that I chose First Majestic Silver and the reason I chose silver miners over gold miners was because I think there's going to be a catch-up trade right there where silver will outperform gold. But I'm bullish on both of them from the fundamental perspective, and then of course the technicals and the short-term price action is starting to match that. But yeah, look at First Majestic Silver if you want to play something like Newmont, but you think it's gone too high already, being that it's already up since the time we were talking about it. It's already up 50 to 55%. You might want to go with First Majestic Silver, which is also a very safe play, but this was more of a play on silver and a pure silver play than it is a gold play. And then, what else did I want to talk about? I also wanted to talk about, well, when it comes to Newmont mining, what's starting to happen is that it is the only gold miner in the S&P 500, and what's happened in the last couple of years is that the S&P 100 has outperformed the S&P 500. And so fund managers, here's the thing on Wall Street, fund managers don't want to have to do something that their colleagues are not doing, or they don't want to have to, analysts don't want to have to do something that their colleagues aren't doing. So if everybody's bullish on a specific underlying asset, they also want to be bullish, and if everybody's bearish, they also want to be bearish. And if they're right, then they get promoted. If they're wrong, then they can just say, oh, well, everybody else was also bullish or everybody else was also bearish. There's this herd mentality with analysts on Wall Street, and you also tend to have with fund managers. So what fund managers started doing was that they started basically coming up with this trick where to collect the 220 fees, or maybe collect a big load or something like that, they would say, we outperformed the market. They wouldn't say they only outperformed it by 0.5%, but they outperformed it. So they take their whole fund, they put in the S&P 100, and they say we outperformed the S&P 500, or they would do a 60-40, where they put 60% of it in the S&P 100, and there was another 60-40 portfolio that put 60% of the allocation in the S&P 500. And so they might outperform by 1% or 2% every year. And so they say, oh, look, we outperformed. That's why we're charging the big fees. Of course, it obviously didn't matter at the end of the day. Nobody should have been paying those fees anyways, but that's what analysts tend to do. And so what many people have been doing is that they've been long the S&P 100, and they just outperform by a few percent. And they say that is a reasonable reason why you should be paying the 220 fees, which of course is not. But the S&P 100 does not have gold mining, so it does not have Newmont mining. Everybody's starting to flip though. Now, everybody's starting to buy more and more Newmont mining, and the fund managers are starting to realize that the S&P 500 will outperform the S&P 100, and they're actually starting to index into the S&P 500 and overweight Newmont mining, whereas before, they would have no Newmont mining, and they would just have all tech stocks, which worked very well because gold prices went from $2,000 all the way down to $1,050, or something like $1,950 all the way down to $1,050, but it worked well for them. But now it's not going to work that well. So now everybody's trying to move into Newmont mining. They're trying to overweight the gold sector, and that's why Newmont actually is going up so much, is because of those indexers and the fund managers who try to justify the 220 and the 6% load and all of that stuff in their mutual or hedge funds. And so that's really why it's outperforming. That's more speculation. I'm not 100% sure, but I have good belief to actually think that that's the reason why, because usually every quarter or so, you'll see reports that come out from big hedge funds and mutual funds about how much they've made, any big holdings that they may have, all those good things. And you'll also see SPDR, State Street Global Advisors, come out and say, oh, we had less inflows or outflows in SPY and VOO. So there were actually still big Vanguard that said there were big inflows in VOO, while State Street Global Advisors said there were big outflows in SPY. SPY is more of a institutional product. VOO, same product, but is more of a retail product. So I look at those different things to try to come up with a hypothesis, but it may not 100% be correct. But just something to look out for right there. Really, that's all I have to talk about today. But yeah, just keep in mind, oil continuation, bearish. TLT is trading sideways right now. We did say it was going to go lower. It has gone lower, just not that lower. SP 500, I originally thought it was going to go lower. I think now that's going to go higher in the short term, but then go lower after 2 weeks. But in the next 2 weeks, I think it's going to have a bit of a blow off top. Russell is going to reach 50% retracement. XAU, USD, watch for breakout, same thing with SPX. And then XAG will outperform XAU. And then look out for the miners. Of course, you can play GDXJ, GDX, but also First Majestic Silver and Newmont Mining, which I still think is undervalued, but wait for a bit of the pullback. And look at the balance sheets. Every Thursday, 3 p.m. balance sheets come out, so go ahead and look at that. And also another thing I just want to add on before I leave is that I think that many people who listen to this YouTube channel oftentimes say something along the lines of, oh, I like what you're doing, but I think it's too risky, or I don't want to have to, I'm just going to sit on the sidelines and listen to what you say, but I'm not going to actually go ahead and participate in it because they think it's quote unquote too risky. Well, just to say it, to put it out there, we outperform the market. And of course, we haven't been around for that long. We've only been around less than a year now. But so far, we've had plays, very conservative plays, like the Newmont Mining play, the bearish Boeing play that we had. I came out with Boeing. And this one, actually, I also posted on TradingView. But basically, I came out somewhere around here on Boeing, and I said that was bearish. And Boeing went down almost 80%. So we tend to have plays that outperform the market. So if you're just one of those people who's on the sidelines, who is looking at these things but is not participating in them because you think it's too risky, keep in mind that we outperform the market. Even our most conservative plays will outperform the market on an annualized basis by over 50%. And we have certain plays like our options plays, Hecla Mining play that we had. I remember I was first episode we talked about Hecla Mining play. That thing, is up in just a couple of months. It became a 20 bagger, for example. So we tend to have a lot of plays like that. So please follow along with the stuff that we do. Of course, risk the money you are willing to lose, but at the same time, follow along, because what matters at the end of the day, it doesn't matter how good you are, how smart you are, how well you see things in the market. What matters at the end of the day is execution. You can have a great business idea, you can have a great trade idea, but if you didn't execute upon it, it doesn't matter. So that's just my thing right there that I'm going to tell you guys, is that, of course, do what you can risk, but we have plays that make thousands of percent. Even the less risky plays, obviously the Hecla Mining was higher risk but higher reward. Even the less risky plays like our Newmont Mining plays outperform the market, or on an absolute basis will make 50-55%, will outperform the market by a very big amount, by basically 70, 75, 80%. Our more conservative plays will outperform the market. So if you're someone right now who's stuck with returns after inflation of 4%, maybe when you get 10 or 20% returns in some passive form of investing, and you're prone to drawdowns of 50, 60, 70%, you maybe want to rethink that and start joining us with what we're doing over here. Other than that, if you have any questions, I'm always checking the comment sections, answering all your questions, going more in depth into things if you want me to. If you have any questions, just go ahead and ask me. And if you have, not just questions related to this, but just any in general trading questions, ask me about it. And after I give a reply, usually I tend to follow up. So after 2 or 3 weeks, If it's a trade idea or something like that, I usually follow up and ask you how everything is doing. So I tend to try to be interactive with the audience. But if you have any questions, the comment section is the place to put them. I'm also on TradingView. You can find me over there. I'm also on StockTwits, and you can go ahead and find me over there if you have any questions. But go ahead, ask a question. I'll hopefully give you a good reply. If not, just tell me that I did it, and I'll try to improve upon it or even make a video about it. And I'll usually try to follow up a week or two later if you have any questions. So other than that, thanks for watching, and happy trading.